Good afternoon to my YouTube listeners, my Instagram followers, and also on TikTok. Great to see you all. My name is Charles Kelly. I'm the author of the book Yes, Money Can Buy You Happiness. And over the weekend, you may have seen one of my reports that I was out with an estate agent on Saturday. And I was surprised to learn that, and he's with a big firm that cover multiple branches in London. He didn't want to be named because he's not an official spokesperson for the firm, but he let me into a little tip. He said, the buyer demand for buy-to-let properties is down 60%, and the Chinese buyers have just disappeared. And this is partly perhaps due to this Evergrande scandal that's going on, the property bubble that's happening over there. And, in the past, Chinese buyers were buying properties all over the world, and that seems to be drying up. And that could be a problem for those cities like Sydney, Auckland, Vancouver, Toronto, perhaps London as well, where a bubble has been developed because of so much demand from China. To a lesser extent in London, I think it's a bigger market here. But he said the rental demand and the rental market is hot again. Renters are coming back into the towns, maybe coming back to work in their offices again, or maybe more students coming in. Stock markets remain at their highest level ever, or virtually there or thereabouts. But as a new report actually finds that households in the UK will remain worse off than they were before the pandemic until 2023. This is the independent forecaster, Office for Budget Responsibility, and their committee, a guy called Charlie Bean, told MPs that incomes would not return to 2019 levels for another 2 years. The main problem? Low productivity, low productive growth. And, he said that the pandemic actually froze large parts of the economy, with many businesses shut entirely. And this is a report from the BBC. So it's interesting to see what happens. We're told that everything's bouncing back, but maybe not as fast as we would like it. So just watch out for that. And yet, the markets are high. Why? Because governments are still pumping money into the economy. The US is printing money and buying bonds, treasury bonds, to the rate of $120 billion per, not year, month. $120 billion per month. If you think of $1 billion, it's a fortune. A billionaire would have enough money to support them, to see them out through their life, their children's life, their grandchildren, maybe their great-grandchildren's life. $1 billion would last that amount of time. You could put it in the bank and just draw off the interest and live like a king without even touching the billion. So when you think that the US government is printing 120 billion of those, billion, and pumping it into bonds just to keep the markets high, when it's really unnecessary. There's a time and a place for everything. Economies go in cycles, up and down. And when it goes down, like the law of the jungle, the weakest companies don't survive. And in the jungle, when you see a herd of wildebeest running from the lions, it's the weaker ones that get left behind and eaten by the lions. It's just law of the jungle. And that makes the herd stronger, right? The herd gets stronger. This is why the male in the herd, the strong one, gets the best lionesses, because that keeps, it's a natural selection process that keeps them stronger. And in the economy, it's a similar kind of thing, right? And unfortunately, the governments from 2008 have artificially kept the markets high. And when it does burst, it's going to be a lot worse than if it was able to just, in a natural correction, that you correct the market, old companies go by the wayside, and new, productive, innovative companies come up. And that's what we want to see for the economy to bounce back properly. What we will see, however, it won't be a correction, it will be a crash, and then your shares could fall down by 50, 60, 70% perhaps. That's what a lot of people are predicting. And that's why value investors like Charlie Munger and Warren Buffett, Berkshire Hathaway, are sitting on a pile of cash, over 100 billion, waiting for the market to correct so they can buy value stocks. They don't just buy stocks because it looks cheap on the sticker price. They buy stocks that are value stocks. They base it on the PE ratios, they base it on the growth within those companies, and they base it on what is really worth, not what the sticker price says. And at the moment, sticker prices are high. You could say the same for properties. If the stock market goes down, properties may not go down immediately, but that they would usually follow. It happens that way. It happened in the 2008 crash. It happened when, I remember back at the 1987 crash, which is around October 87. Big hurricanes came like at the moment in the UK, and then the market crashed. You had Black Friday or Black Monday, I can't remember what it was, but it crashed, it dropped like a stone. And then about a year later, property started to drop because it brought in a long recession, a hard recession into the 90s. And it took 5, 6, 7 years before we came out of that. So do watch out for that. If you think you don't invest in shares, look at what your pension money is in. Have you got an ISA invested in shares? Have you got a mutual fund? Have you got a unit trust? Just think about that. So there you go. Remember now that financial education, as you find out in my books, Yes, Money Can Buy You Happiness, is important. So do like and subscribe if you're watching this on YouTube. Share it if you're watching it somewhere else. And you know, I always appreciate your comments as well, whether they're good or bad. For me, do keep in touch. Let's get that engagement going on the channels. So thanks for listening. And if you're interested in any free training on money, how to become financially free without working any harder, then do click on my free training. I'll put a link up there. And as I said, subscribe and like. Thanks for listening and have a great evening. Bye for now.